Hello everyone, welcome back to the Weekend Charts. Charlie Bilello here, another huge show for you today. A lot to talk about, so stick around to the end. Hit that subscribe button. We're going to run through a lot of topics today. CPI report came in a little bit hot. Going to start with that. Then we're going to talk about car insurance. You've probably noticed it's been going up and up and up. Rate cuts have been pushed back. So we're going to talk about the Fed and expectations there. Nvidia this week passes Amazon and Google in terms of market cap. Incredible story there. U.S. consumers, some concerns after the retail sales report came in worse than expected. Used Teslas now 50% off. Going to discuss that and that transition away from EVs of late in terms of consumers. The trade deficit in the U.S. is narrowing, so we're going to discuss that. The U.S. government continues to borrow money to pay interest on its debt, and that continues to rise every single month. And we're going to end with higher wages and lower food price inflation. Some good news, as we always end with. So let's start out with that inflation report. Came in worse than expected, which means inflation was higher than predicted. And if we look at that overall CPI, 3.09%. So it did come down versus the prior month, but it was expected to fall to 3%, so a little bit worse than expected. And the core CPI reading actually came in much worse than expected. It was expected to drop to 3.7%, only fell to 3.87%. Still, trend in terms of core CPI moving lower. That was the lowest core inflation reading we've seen since August 2021. And if we look at the major components and we compare them to June 2022, a lot of good news in here. With the exception of transportation and shelter, every other major component is lower today than it was back in June 2022 when CPI peaked at 9.1%. And we're seeing continued outright declines on an absolute basis year over year in used cars, gasoline, fuel oil, gas utilities. New cars now almost flat in terms of year over year. We got apparel barely higher year over year. So a lot of good things in the CPI report, despite the actual numbers coming in a little bit worse than expected. Now let's dig into the most important component. That would be shelter. Over a third of the index is this shelter component, and still showing an above average rate of inflation here, 6%, but it continued to move lower. So this is now 10 straight months of lower shelter CPI on a year-over-year basis, down to 6%. The market was definitely expecting this to be lower than 6%, but the trend continues. And you can see here this wide gap between the shelter CPI reading and real-time data. Looking at apartment prices, they're actually down 1% year over year. But this operates, as we always talk about, with a huge lag. So the expectation would be that this would continue to move down in the coming months to really close this gap in terms of that lag. And that's exactly what the Cleveland Fed is predicting for February. Their initial reading here is that core CPI will continue to move lower and actually move down to 3.7% year over year in February. And that will be driven in large part likely by that shelter component showing a lower rate of inflation. And in terms of the actual versus the reported data here, this is very interesting now. The fact that since the beginning of 2020, we actually have shelter CPI up 21.8% versus US rents. These are asking rents up 19.2%. So that huge gap that we saw for over a year where the shelter CPI was understating true increases in terms of rent prices. Well, now we've closed that gap and then some. Now, there still is a wide gap between shelter CPI and home prices, which are up well over 40% since the start of 2020. But in terms of rents, now we've definitely caught up. So this is more reflective of reality in terms of what the actual housing inflation has been since the beginning of 2020. And if we exclude shelter, and I don't often like to do that, but it is the biggest component. And if we take it out, because it is such a lagging indicator, what we see is something interesting here, that the CPI is actually below 2% for 8 consecutive months without that shelter component. So remains to be seen that what will happen in the coming months. The other components, of course, could start to go up and this graph would change. But assuming that doesn't happen and assuming shelter does come down, we should get closer and closer to the Fed's 2% target at some point this year. So looking at the car insurance part of CPI, Not very good news there. And you probably noticed if your car insurance is coming due, the price increases have been extremely high. I definitely noticed that I had to do a double take. So is that correct? It is correct. The car insurance companies are increasing rates by the fastest pace that we've seen since the 1970s, 21% increase over the past year. Just huge, huge increases. And if we look at the last 10 years, this is really a continuing trend for auto insurance prices. I'm looking here in the light blue line, 85% increase in auto insurance rates over the last 10 years. One of the big drivers of that is the increased cost of maintenance and repairs, which is up about 50% over the past 10 years. And if we look at overall consumer prices, we're down at 31%. So much, much higher in terms of the increase in car insurance and auto and maintenance repair versus the overall CPI. And who's benefiting from that? Certainly car insurance companies. Here's one example: Progressive, the largest U.S. publicly traded company that focuses on car insurance, up 881% over the last decade versus a 227% gain for the S&P 500. Now, let's talk about the Fed and market expectations. Immediately after that CPI report comes out, you see a market respond by saying March is off the table, pretty much a done deal. We're not going to see the Fed cut rates in March. We actually saw the probability go below 10% in terms of expectations for a cut. And just a month ago, if we look back a month ago, we were looking at 77% probability of the Fed cutting rates in March. So huge change over the past month. A number of things driving that. We have stronger employment. We have this now hotter than expected inflation. And so pretty much market saying, as we get closer to that March meeting, if these are the expectations, there's pretty much no way the Fed will cut rates. And more importantly, I think, is the expectations for how many rate cuts this year. We came into the year and we talked about this in early January, saying that the market was extremely dovish in its expectations, thinking that the Fed was going to cut 6 or 7 times this year. Well, that definitely has changed here. If we look at this curve here, we're now looking at maybe 4 rate cuts in terms of the market's expectations for this year. So huge difference. That would leave the Fed funds rate, if this is correct, at around 4.4% by year end. And the expectation coming into the year was well below 4% by the end of the year. Now, all of this data will change, but it shows you just how important data points can be. And we've seen that strong employment report coupled with this hotter than expected inflation report really changed the odds. And in terms of my thinking, this is actually what the Fed should be doing. They shouldn't be cutting rates this soon. And the reason is we see this gap here continues to widen. So now we've had 3% inflation over the last year, which is great. We've come back down from 9%, but it doesn't close the fact or change the fact that prices are now well above that 2% trend. So the Fed keeps saying they want to get inflation back to 2%. I agree, they should want to get back to 2%, but that doesn't erase the above 2% inflation that we've seen since the beginning of 2020. So in my view, the Fed should hold off on easing policy until we see this trend line come back. I don't think that they're going to do that, but at least be hesitant to cut rates until you see at least some evidence that this is not only going to come back down to 2%, but start to close that gap. So it really comes down to how employment looks in the next few months. If employment continues to be strong, unemployment rate continues to be low, well, that gives the Fed more time in terms of its ability to keep restrictive policy and to really focus on inflation. So a lot of data points between now and June, which is when the Fed is now expected to cut rates according to Fed Fund futures. A lot can change between now and then. But in terms of that March meeting, unless something drastic happens between now and then, it seems like rate cut is off the table. And I think that's the right move for the Fed. We got to talk about Nvidia again here. This is becoming a consistent theme, but it continues to march higher, and crazy, unbelievable this week. This really shocked me that it actually passed Amazon and Google in terms of market cap. So first it passes Amazon to become the 4th largest US company, and Amazon 575 billion in terms of revenue, Nvidia down at 45 billion. Yes, Nvidia is going to report soon, and their revenue is going to go up, but it's nowhere near Amazon in terms of what it's offering, in terms of its products, in terms of the depth of its business. To me, this is an incredible stat, the fact that it surpassed it. And then later in the week, it passes Google. Just unbelievable. Again, huge gap between revenues of Google, revenues of Nvidia. So market expectations right now are extremely, extremely high for Nvidia. They're essentially saying that Nvidia is going to close the gap in terms of profits between Google and Amazon and Nvidia, and actually close that gap relatively quickly. And that growth rates are going to continue to be astronomical in the years to come, not just the quarters to come. So they've really pulled forward a lot of the expectations. And really, if anything goes wrong from those expectations, it's going to be a very difficult time for Nvidia shareholders. If we look at the price to sales ratio differential between Nvidia over 40 times sales versus Google 6 times sales and Amazon 3 times sales, you can see just how high those expectations are. So far, Nvidia has not only met expectations, they've exceeded it. And the question is, will they be able to continue to do so, even with the stock up this much? And really, just thinking 10 years from now, is there not going to be a competitor that steps in and takes market share from Nvidia and forces them to cut their prices, to lower their margins? It's hard to believe in a competitive economy with something so important, really the fuel for AI and the AI revolution being these semiconductor chips. It's hard to believe that Amazon, Google, and the rest of big tech, Microsoft and Apple, aren't going to get together at some point and want to pursue a lower cost alternative. But for now, Nvidia surging on momentum here. We're looking at year-to-date returns, 49% already for Nvidia. We're only in the middle of February. Meta's up 34%. So those two stocks well ahead of the rest of the Magnificent Seven. Tesla actually down 24% this year. And just a big start to the year for the Mag 7 overall, kind of continuing the trend from last year. The question is this sustainable? And it didn't seem like it after Nvidia was up 239% last year, but already 49% so far this year for Nvidia. And the big reaction is going to be what happens in terms of earnings. Expectations are very, very high heading into it, and we'll see if they can meet and maybe even beat again those expectations. So let's talk about the U.S. consumer. Some concerns here after a worse than expected retail sales report. These numbers can be revised, so I wouldn't put too much weight on it, but interesting to see. We really had the first decline in retail sales on a year-over-year basis since May 2020. So just unusual to see that, of course. Again, it could be a one-off, and perhaps this will be revised and the data will change. So I don't want to read too much into it, but you don't tend to see, obviously, declines on a nominal basis outside of recession. If we include inflation and adjust for inflation, we're actually seeing retail sales down 3% over the last year. So very important will be the next month's report to see if these revisions are occurring and what's a possibility, a possible reason why the consumer might be getting a little bit more stressed. Well, the rising interest rate picture is more and more difficult if you have credit card debt. And if we look at the credit card debt increases over the last year, another 14.5% increase in Q4 2023. And the reason that's becoming more problematic for people is that the interest rate on that debt hit another record high. So we're looking at 21.5% on credit card debt interest rate, highest level on record. And if you look at March 2022, before the Fed cut rates, you're looking at 14.5%. So 7 percentage point increase in terms of the rate that you have to pay for credit card debt. And that could be one of the concerns in terms of the consumer. Perhaps more of this money is going to service that debt in terms of higher interest rates, and then less is available to buy products. Now, if we look at auto loan rates, they continue to increase, highest since 2001, 8.5%. now, so up from 4.5%. So you're seeing 400 basis points increase in terms of the cost of financing cars. Most people finance cars. 80% of new cars are purchased with a loan. They're not paying cash, most people. So there's just hitting demand. And that could be another reason in terms of retail sales for seeing a year-over-year decline. So don't want to make a lot too much out of that one report. So we'll wait to see. But certainly, if this becomes a trend, you're looking at more problematic situation for the economy, given that the U.S. consumer is such a big driver there. Now, terms of these auto loan rates, what is it hitting? It's not just hitting new cars, it's also hitting used cars. We've been talking about the average price of a used Tesla for months, and this trend really continues here. We're now seeing the average price of used Tesla down to 33,900. That's more than 50% off the peak price that we saw in 2022 of 67,900. Just a stunning decline in terms of the average price here. And we've talked about the Tesla cutting prices on new cars. That's a big factor. And you're just seeing supply outweigh demand, prices coming down, these vehicles becoming more costly in terms of maintenance. That's driving it down. And it's a trend that doesn't seem to be at the end just yet. So we could see this really start to converge. I think the average price of a vehicle overall is only around 28,000. So you're getting closer and closer. It used to be a premium product in terms of buying a used Tesla just in the middle of 2022. And here we are a year and a half later, and it's becoming close to the average price of a used car overall. And interesting report out of the Wall Street Journal looking at the EV market. And we've been talking about for a few years that surge in EV demand as a percentage of overall sales. It was going up and up and up. And certainly the tax credits were a big factor in terms of driving that higher. If you're getting $7,500 off a vehicle, that's a huge incentive. But interesting, of late, we've seen in the most recent months, the share of EVs go down in terms of the percentage of sales. And what the Wall Street Journal was talking about is looking at dealers and talking to dealers is that there's simply less demand now for EVs, and a number of things driving that, but cost being one of the biggest factors in terms of there's still this gap between EVs costing more than other vehicles. And if we look at inventory here, this is really the proof that they're becoming harder to sell. We went from a situation where there was a backlog, not enough electric vehicles, and a backlog in terms of demand. And now we have the situation where they have built up EVs on their lot that they can't sell. Days of inventory much higher than for gasoline or hybrid vehicles. And what we're seeing here is this really start to be a factor. And I think the interest rate situation certainly exacerbates this, where electric vehicles, even with the tax credit, are still higher priced than gas vehicles or hybrid vehicles. And that's having an impact on demand. So if you look at Ford, you look at GM, they've talked about it in recent months. They're pulling back on their EV investments. They're losing money on these battery car businesses, a stunning amount, lost 4.7 billion last year in terms of Ford, in terms of their EV vehicles. And this year they're projecting 5 to 5.5 billion. And what they're saying is they're going to increase production of hybrids. And that's what Toyota really has migrated to and been very successful for. So be interesting to see if this continues. It seems like, once again, the EV market, we're getting closer. There is real demand there, but the market got ahead of itself a little bit in terms of building all of this infrastructure and really overproduction for the existing demand. So we're not quite there yet in terms of the pricing for EV vehicles, especially given the high repair and maintenance costs. We're not quite there yet in terms of where a consumer is essentially indifferent between making that choice. And the hybrid seems to be the best of both worlds, where you don't have to worry about range and you don't have to worry about the other battery issues as much as EVs, and it comes at a much lower price point. So that seems to be, for now, the sweet spot for consumers. and we'll continue to watch this throughout the rest of the year. But just stunning, stunning declines in terms of the pricing of Teslas. We know Musk wants to get as many Teslas on the road as possible. That seems to be the explicit goal for Tesla, regardless of profitability. They're giving up profitability to try to take more and more market share. But the question, I guess, now is, are we going to see demand pick back up, and we're going to start to see inventory levels come back down again? So good news for the consumer is if you're looking for an EV, you're likely to see prices come down over the coming months. Certainly, if you're looking for a used car, they've already come down a lot. So I want to talk about the narrowing trade balance here. This was an interesting stat. So 2022, we actually saw a record trade deficit for the U.S. So the U.S. 951 billion trade deficit in 2022, the biggest on record. And in 2022, interesting, we saw that trade deficit narrow to 773 billion. So significant reduction just from 1 year. And what's driving that? A big portion of that is coming from a reduction in terms of the trade deficit with China. So if we look at China here, narrowest trade deficit with China, you have to go back a long time in terms of this trade deficit. And where is that going? Well, we're increasing our trade with other countries such as Mexico. You can see here a record trade deficit moving the other direction, 150 billion. But the reduction from China outweighed the increase in trade with these other countries. So just an interesting scenario here. U.S. doing less trade with China. We've talked about that a lot, so I won't get into it again. But interesting to see this reflected in the statistics here. The U.S. trying to migrate away from its dependence on China a lot in terms of we were highly dependent just a few years ago and becoming increasingly less dependent. And with countries like Mexico, countries like India, there seems to be more and more demand to build up manufacturing capacity over there to migrate away from China. So perhaps this is a secular trend that we're going to see continue. And a good news for the U.S. is that it has more diversification. It's not as reliant on China, which we saw during COVID that was a dangerous position to be in. So I think overall this is a net positive for the U.S. and U.S. companies. Let's talk about the debt and the deficit here. The U.S. continues to borrow money to pay interest on its debt. National debt continues to increase, and the interest on that debt is increasing at a very rapid pace. And the reason for that, of course, is that the old treasuries that were issued were at much lower interest rates. New debt is being issued much higher interest rates, and now the interest expense on that debt is skyrocketing higher. We're up to 975 billion just in interest expense over the last year. That's a record high. And if it continues at this pace, it won't be long before the interest that we're paying on debt, on our national debt, is actually the largest line item in the budget. So this will continue as long as interest rates remain elevated and as long as we continue to borrow at the rate that we're doing. So where is that at? We're at 1.7 trillion in terms of the deficit here. Just a stunning number in terms of we have an economy that's still in an expansion. We have a very low unemployment rate at 3.7%, and yet we're running a deficit of 1.7 trillion. And bigger and bigger portion of that deficit is going to become just this interest expense alone. So it becomes kind of a spiral on itself because we're not cutting back anywhere else, and interest rates are higher, and we're continuing to borrow. We have the existing debt. So even if there wasn't a deficit, we're going to be paying more. And the fact that there is a deficit means this just really compounds. So I expect within the next few months, we're going to unfortunately see this go above $1 trillion. And maybe then, perhaps then, that number, the round number of $1 trillion, maybe that will get enough attention where we start to really focus on this before it becomes a real crisis. So I want to end, as I always do, with talking about something positive. And the most positive thing I can think of here is the fact that we have higher wages and lower food price inflation. Once again, if we look at food prices. This is prices at the grocery store, up 1.2% over the past year. That's the lowest food price inflation we've seen since June 2021. We were talking last week about McDonald's and crazy increase in prices at places like McDonald's and other restaurants, just stunning increasing last year, 10% increase in 2023 in terms of prices there. The good news is consumers have an alternative. More and more, it's becoming cheaper to shop at the grocery store and cook your food at home versus going out to a restaurant. And the most important chart for an economy is the spread between wages and inflation. This is what leads to prosperity over time, increases in real income. So if we look at the spread here, 1.36% over the past year. Great news. It's the 9th straight month where we have a positive year-over-year gain. Of course, that was following 25 consecutive months of negative growth, but slowly but surely, we're coming back. The consumer should be feeling better about this, so I don't think that retail sales situation will stay there for very long. If this continues to be the case, we're going to see consumers with more money in their pocket. They're able to spend more, save more, invest more, and hopefully this continues. It will continue for February because we're probably going to have around 3% CPI, and wages are still running at around 4%. But this is just a great sign for the American worker, and hopefully this continues. So we're going to end it right there. Have a great weekend, everyone. Thank you for joining me. I'll see you next time on the Week in Charts.